Good afternoon, everyone. The most remarkable news of this week is certainly that we are today presenting as Team Internet rather than CentralNic, which is a choice that we have made given the fundamental pivot that the group has gone through over the last 10 years. Not everyone might know, but the NIC in CentralNic stands for Network Information Center, which is what a domain registry does. So a domain registry are organizations like Nominet, who run .uk, or Verisign, who run .com, which by today represents roughly 1% of our group revenue. So it is today not a very good description of what the company does. And we've therefore chosen the new name of Team Internet, and we'll explain some of the reasoning as part of this presentation. Next slide, please. So we've structured this presentation in 4 chapters: highlights, business profile, financial results, and a section strategy and outlook. I'm going to run through the first 2, and then Billy will take over for the financial results, and I'll then do the wrap up in the strategy and outlook section. So let's jump straight into the highlights, which is a video, and I will now hold my breath for 90 seconds. Thank you. And I'm not sure why the music didn't play. Normally there's some motivating, enthusiastic, and engaging music in the background of the video. But the key messaging that you've already seen as part of the video is that we did not only choose this name because in 2019, we happened to acquire a company called Team Internet AG in Munich, Germany. We've chosen this name because of the meaning of the 2 words. So the team stands for a group of individuals who combine the efforts, which are our people, our businesses, and our technologies. And Internet stands for the interconnected network that we all use for our daily lives. And it is here where we find our customers and our partners. And what connects all of this is the word connection, because it is connections that are the common thread that basically unify both our online marketing and our online presence business, where we either connect a domain registry to a web hosting company, or where we connect a website operator with an advertiser. It is always about connecting other people to create value for us and for our partners. Next slide, please. Also, only last Friday, we've announced another acquisition of a company called Adrenalad. Adrenalad is based in Los Angeles, California. And Adrenalad, using the same narrative as we do for the group, is connecting unused domain names, which is a business which we already operated through our subsidiary Parking Crew. And however, rather than monetizing the traffic using a Google feed, here they are translating the views on the dormant domain names into actual e-commerce transactions, something where we want strategically to move towards. And therefore, we are very happy that we can announce that we've not only done a strategically important deal, but also a financially very, very lucrative one, where we only paid $2.4 million for an additional $2.7 million of revenue and around $700,000 of profits. And this will now become a new component of our group. Next slide, please. Speaking about the group, here, even though the figures are already out since like 3 weeks, again, our half-year results, the gross revenue is up by 18% to almost $400 million just in the first half of this year. Our net revenue, that is the gross revenue less pass-through expenses like traffic acquisition cost or registry fees in the online presence business, has grown to more than $91 million. And our adjusted EBITDA has grown even faster than the net revenue, which means by now we almost convert 50% of the net revenue into EBITDA, demonstrating the cost discipline that we exercise. And given that we've also exercised cost discipline on the items below EBITDA, just down to the net income of the group, in combination with the share buyback, to which we will come a few slides later, our adjusted EPS is up by 34% to now more than $0.11 in the first half of this year. Billy will go into the reasons why we've seen a temporary spike in the net debt, which still remains on a very manageable level, less than 1 times the annualized EBITDA, and also less than 1 times the annualized adjusted cash flow. But I will not steal Billy's thunder. He will go through the financials in more detail later. Next slide, please. So how does this growth that we see break out between the two segments in which we report? Just for completeness, here on this page, we are looking at trailing 12 months figures rather than just the first half of 2023, where we see that the revenue, that the organic growth of the online marketing division was 36%, and the growth of the online presence segment was 15%. And we are very proud of both accomplishments, because first, 36% growth in online marketing is something that most peers can only dream of. And in online presence, we are particularly proud at the fact that after many years of only mid-single-digit percentage growth, we've now been able, within only 6 months, to dramatically accelerate the growth of this business too. 15% to be precise, and $171 million of revenue. Just for those who are new to this case, since 2019, we report organic growth, and we measure organic growth in the same consistent methodology. The blue part of the bars is the actual reported revenue for the trailing 12 months. And the green part is the additional revenue that we would have reported if all today's constituents of the group would have already been parts of the group since the beginning of the prior year comparison period. Here, this $35.1 million is mostly an adjustment for Vergleich.org, which we acquired in early 2022, so in the middle of the prior year comparative period. Next slide, please. And Team Internet is an ambitious group. Our ambition is not anything less than world market leadership in all businesses in which we operate, or at least national leadership if it is a national market. And in our online marketing business, we've identified System One, a US corporation, not to be confused with the System One Group PLC here on the London Stock Exchange, as our most comparable business. We would estimate that 75% of the activity is identical to what we do in our online marketing segment. And in the 3.5 years since 2020, we've gone from 42% of their revenue to now 97% of their revenue in the first half of 2023. So we've almost caught up with the level of their revenues, and hopefully at some time in the future we will see a triple-digit percentage here. And also in online presence, we've grown our revenue from 55% of the revenue of Tucows Domains, our largest competitor, where we really look at what exactly we do in the domain name industry, to now 77% of the revenue in the first half of this year. So also a 40% relative increase of the relative market share. And if we were able to continue this trend in not too distant future, we would also catch up here to market leadership. Next slide, please. And what do we do to keep this organic growth high? It's innovation on the one hand, and new partnerships on the other hand. And here we are just showing the events that have happened since we reported our Q1 results. So we started Meilleur.fr, the French clone of our German leading Vergleich.org product review portal. It is of course now in its infancy after less than 4 months of operations, but we are confident that with our industrial logic, we will be able to also gain market leadership in this market. Then later, we've been selected as one of only 2 providers globally for critical domain services to the UK government through the Crown Commercial Service, which is of course now fantastic, given that we can pitch for all the business that the UK government has is going to assign to different parties with only one eligible competitor, and we will continue to report on the wins that we will make within the frame of this framework agreement. And then we've signed up 4 partnerships with unicorn status partners: Sovereign, a leading supply side platform in the online marketing industry; Klarna, one of the market leaders in buy now, pay later websites; Booking.com, which is by today certainly a household name. Quite a few of you might have booked their summer vacation through them. And last but not least, also Shopify, the giant in e-commerce out of Canada, one of the largest contenders to the leadership position of Amazon. And it's important to us to show this because everyone, of course, knows about our strong ties with Google and Amazon, and obviously we also want to build partnerships with all the other large companies that define this industry. The last item that we want to highlight here is Internet.bs, one of our retail domain registrar platforms. And here we were the first provider on this planet to offer an AI-powered domain search. So when you look for a domain name that you want to operate and it is taken, classically quite poor alternative proposals would be made, like adding a 24 or 365 to the end of it, or adding something like hyphen site behind it just to create a string that no one has registered yet. Now with this AI-powered tool, we basically have the entire richness of the human language at our fingertips, and the system can come up with much smarter proposals what domain names to take. And this is not only a cool feature, it is also paying off economically. So our conversion rates have materially improved. So with the same budget that before with the same marketing budget that before bought us 100 new customers, we can now win 120 new customers, which will over the years pay off also for the shareholders. Next slide, please. When discussing the EPS, a few slides before, I mentioned the share buyback program. So we've already done a share buyback program, which we announced on the last day of 2022 and completed somewhere in mid-January. We've then started the second share buyback program with a volume of 4 million sterling on the 15th of May. However, given the success of the program, we then on the 3rd of July, we decided to top it up by another 30 million sterling to now a total of 34 million sterling, with the objective to pretty much use up the entire volume of share buybacks that the AGM has granted the company, basically listening to the vote of the shareholders and living up to it. Next slide, please. Business profile. So on the first slide in the business profile section, you see that we have assembled quite a number of different brands, 45 to be precise, under the roof of Team Internet. What is, however, more relevant than the number of brands that we currently have in the portfolio, some of them are being stars, some being the newcomers that will hopefully carry the group or add to carrying the group in the future. And some of them we might actually choose to merge to reduce the complexity of the group. The most important thing is here that among these 45, we have quite a few which are true market leaders, which we will see on the next slide. So we have TONIC, which is like the centerpiece of our relationship with Google, and which we believe is the leading Google AFD partner. AFD stands for AdSense for Domains. And without going into detail what that exactly is, and we've presented the workflow on several occasions in the public domain. Here we have a true global leadership position. The same applies to Parking Crew, where the market is more opaque, but we are very confident that we also here among the 2 or 3 global market leaders for domain parking services. Then in Germany, we are only German-speaking Europe, to be more precise. We are the #1 product review portal with our Vergleich.org, which we've now carried over into France, as I mentioned before. CentralNic Reseller, the second largest global domain name distribution network, so a competitor to Tucows Domains in Canada. And conscious of time, I'm skipping to CentralNic Registry, which is the oldest brand in the entire portfolio, basically the stem cell from which the group was created, and which is still the #1 registry service provider for NTLDs. NTLDs are all the new top-level domains, so alternatives to .com or .uk, which have been released back in 2012, which includes domain extensions like .xyz, .site, .online, .icu, and others. And here we have a 45% world market share. Over all these different brands, we connect a vast network of different supply side categories like traffic from social media or search ads or domains, domain supplies like .com, or currently hot selling extensions like .ai or .io, and value-added services like Microsoft 365. And here we're constantly exploring adding new categories of supply, and also then adding in each category, constantly adding new partners. You've seen 4 very prominent examples a few slides before when we were discussing Klarna, Booking.com, and others. And also on the demand side, we've connected to quite a series of different types of demand side partners. And this network will only grow over time, giving us more network effects and then fueling the future growth of the group. Next slide, please. While all this might look quite complicated, you still can you can still describe both our segments materially with two KPIs. In your online marketing business, it is the number of visitor sessions, so how many people have embarked on one of our consumer journeys through which we educate consumers and convert them into high intent customers, where the number has gone up from 3.5 billion to 5.3 billion. And just think about that. So our main market here is the United States, representing roughly 50% of the revenues in this business, which means that every American with an internet access visits one of our websites roughly 10 times a year. So it is a mainstream phenomenon. In the meantime, people really love what we offer to them, and this is why each year more and more people engage with us. And another sign of success is our RPM. RPM stands for revenue per thousand. The M stands for mille. I'm not sure why people have not used the T for thousand, but anyway, this number has remained flat. And while normally flat does not mean excellent, here it does. It is not a secret that advertising prices have come down. From public sources, you could see that the average click price on the Google network has dropped by 10% in the same period. So here, standstill means progress, and just is another testament to the excellence and the value created through the service that we provide. And in the online presence business, same thing. One volume driver, one price driver, here being the number of domain years processed and the revenue per domain year processed, both up by 7% and 6% respectively. So here we can both grow and increase the price quality. On the right-hand side, this is just for information purposes for retail investors who don't have access to paid research. But I'll just leave these figures uncommented and leave it to the judgment of the audience what they think about them. And with this, I think I hand over to Billy. Is that correct?
Yes, that's right. Thank you, Michael. Next slide, please. So a couple of brief highlights on the financial statements. Conscious of time, and that many of you will already have seen our strong H1 results. I'll only give you a highlight or two per page. So in terms of the income statement, as you saw from the highlights earlier in the presentation, there are a number of significant growth factors throughout the company's income statement. We will examine a couple of slides further on the situation with our operating profit. We continue to be highly profitable at an operating profit level, and we continue to drive increased operating leverage. There are some factors such as share-based payment expenses and amortization expenses, which naturally impact operating profit. But right the way down the P&L to profit before tax and profit after tax, we are driving increased levels of profitability in line with CentralNic's growing sophistication and maturity as a company over the last several years, moving from a positive adjusted EBITDA to actually delivering bottom line profitability. Next slide, please. In terms of the balance sheet, it's quite important that I describe in a little detail why we've had a manageable and forecast increase in net debt over the first 6 months of the year. And as you'll see on the right-hand side of the page, although net debt increased, that was due to two factors, essentially. The first couple of bullets there refer to a deliberate strategic decision that we were very comfortable to use some of the surplus available operating cash that is generated by the business to return cash to shareholders, something which was not necessarily a high strategic priority for the Team Internet Group when it was called CentralNic up to and including last year. But this year it's been a high priority to us to return cash to shareholders, and we've found two avenues to do that. One of which was we paid our inaugural dividend in Q2 of this year, and that sets off a progressive dividend policy, which we'll be very pleased to commit to over the company's remaining life. And then the other The other optional way of returning cash to shareholders, as we announced, as alluded to earlier, a material expansion of our share buyback program, and that is proven to be very popular with shareholders in terms of tidying up and making more efficient our capital by taking advantage of opportunities to repurchase shares of the company. The final bullet there is also important in terms of understanding the increase in net debt, and that is that we had a material amount of non-recurring, so one-off deferred contingent consideration payments within the first half of this year, payable to the former owners and current management of businesses we've acquired over the last several years, and where those businesses have performed in line with, or in most cases above, the expectations that we had when we acquired those businesses. We are naturally very pleased to follow through on our commitment to reward those former owners and current management respectively. So as you'll note, if you were to add back those uses of cash there, the returning of cash to shareholders and the settlement of deferred contingent consideration, which will not recur at the same levels of materiality in the second half of the year, we would actually show an increase in net debt absent those factors. Next slide, please. On the next slide, we'll show, just to show the underlying cash conversion. Operating cash conversion for Team Internet continues to be targeted at least 100%. We will always attempt to convert our strong operating profit growth into operating cash generation. In the first half of this year, you'll see on the right-hand side of the page, having overachieved in terms of the target in 2022, we have not quite hit the 100% target so far this year, and there's a number of working capital and other initiatives we're looking at in order to ensure that we have the best possible chance of delivering 100% plus operating cash conversion for the full year, and certainly for the second half of the year, so that we continue to play in the space of converting one-for-one operating profit to operating cash. Next slide, please. In the interest of time, just want to reiterate the point that I made earlier, that the company is continuing to deliver strong levels of profitability right the way down the P&L, right the way down to profit before tax on this slide, and even to profit after tax, which happens not to be on this slide, but you may have seen in our recent filing. We are a profitable business right down to profit after tax. We are laser focused on not only delivering strong revenue growth and strong adjusted EBITDA growth, which have been a focus for CentralNic for many years, but also in delivering absolute bottom line profitability, so that we can add shareholder value and then use that profitability and the operating cash that it generates to return cash to shareholders. So for any of you that have noticed that the operating profit of the group was slightly lower in H1 of 2023 versus 2022, it's important to point out that there are some material non-cash items which we are obliged under IFRS to include with an operating profit. One is share-based payment expense. The other one to draw your attention to is the amortization of intangible assets is 4.5 million higher in the first half of 23 than it was in 22, and that is primarily a non-cash charge. It relates to amortization of intangible assets acquired as part of our M&A processes. So in terms of cash profit, the picture shows growth, and it's only by including some of those non-cash items, such as amortization of intangible assets, that operating profit, while still strong, is lower than the first half of last year, and we're targeting growth in operating profit at all levels in the second half of this year. Next slide, please. And I'm now ready to hand back to Michael to take us through the strategy and the outlook.
Thank you, Billy. So I hope you all agree that the financial results of the company so far are quite impressive. But what is, of course, more important is what do we intend to do to keep it that way. And we have a laser focus on organic growth by winning new customers, growing the existing customers, and launching new products and contracting with new suppliers. We had a specific slide just on the recent major successes on this last bullet point. And this organic growth, in combination with our disciplined approach to cost, leads to operating leverage. You've also seen evidence of that in the financial highlights, where again, EBITDA has been growing faster than our net revenue, constantly converting more of the net revenue, which is our value added, into profits for our shareholders. And the increasing level of profit then leads to more competitive cost of capital. So in October last year, we had a major crystallization event of our cost of capital becoming more competitive when we refinanced our bonds that we initially issued in 2019 and in subsequent tranches through a bank loan, where we were able to reduce the interest margin from 7% to 2.75%. That's a more than 60% reduction, which makes that even in the first half of this year, we've paid less interest than in the first half last year, despite the general increase in market rates that we all know from the news every day. And because we had the success on managing the cost of our debt, we are now focusing on managing the cost of equity. Hashtag share buyback. We also had a slide on the share buyback earlier in this deck. And then the competitive cost of capital again allow us to do focused bolt-on acquisitions, just like Adrenalabs. Again, a slide that we presented in this deck. And each of these bolt-on acquisitions then again creates new adjacencies where we can connect to new partners and continue to increase our network, driving further organic growth. And then the entire virtuous circle starts all over again. Next slide, please. Of course, in 2023, no investor presentation can be without a slide on artificial intelligence. And artificial intelligence for us is not anything new. It has always been at the core of our business operations, mostly in the form of machine learning. We constantly redesign all our websites on a daily basis and constantly adapting them to new trends, whether it's slight changes in the contrast between the fonts, between the font and the background color, or whatever changes it is. But now with this new generative AI, again, new application fields are being created. And this is why we are enhancing our AI capacity, secondly, accelerating the impact on our business, and thirdly, scaling our AI advantage. And some examples are the AI-based domain search that we already mentioned, which has direct, tangible results on our business outcomes. We strategically integrated AI in our processes at VGL or Vergleich.org, which is the brand under which it operates in Germany, where we are now much faster in content creation and can onboard more white label partners to whom we license content to further weave our net. And last but not least, we're also using AI to analyze all the data from all the different domain platforms that we own, which then helps through a customer relationship management tool to accelerate the growth in this business. And you've seen the outcome. The growth has gone up from mid-single digit to 15% growth in the online presence business. So huge successes on the AI front. And in order to further enhance this, we intend to start an innovation hub in 2024 and also create an internal AI academy so that all staff, not only a few senior leaders, are being trained on all the AI tools to become more effective in their daily tasks. Next slide, please. Many people have asked, what is the link between our Tonic product, which is currently the main driver of our revenue and profits, and our Vergleich.org. VGL is the company that operates it. And with these two businesses, we have two different skills. Tonic is great at acquiring traffic on social media and monetizing it, matching it with Google search ads and making money, even though Google only remits a part of the click price to us. And then we have a second business which can pay the full Google click price and is so good at translating this search ad traffic coming from Google into actual e-commerce transactions at Amazon that it again makes money. So when you have these two skills, ultimately, you should also be able to translate social media traffic directly into e-commerce transactions. And so this is our vision where we need to get to over the next couple of years, which is basically the holy grail that everyone is looking for. You also see that Meta has and TikTok have ambitions here. Meta started the marketplaces, for example, on Facebook. Currently, TikTok Shop is all the hype in the online marketing industry, and also Amazon has already done, coming from the other side, has already now launched its 5th social media platform by the name of Inspire. However, while we're here while we're pursuing the same idea as these titans in the industry, we differentiate ourselves again through the connection theme that you've been seeing on the slide of the rebrand. Rather than trying to be the best social media platform and the best e-commerce company at the same time, which is a very daring promise, our approach is to connect the best social media platform with the best e-commerce company and creating value this way. And we don't know what share of the market we will get. However, McKinsey estimates that the market could be as big as $80 billion by 2025, and we clearly want a slice of it. And the market is big enough for all the players in here, and we believe that our alternative approach to the approach of Meta, TikTok, and Amazon is promising, and we will see over the next quarters how we advance on this subject. Next slide, please. So this is now the recap. So Team Internet operating in 2 highly attractive markets, high growth, digital advertising, our online marketing segment, and domain name management solutions, our online presence segment. Both of them have a critical role in the industry. Both of them have recurring revenues, online presence through subscription revenues, online marketing through utility style revenues. Every morning, people wake up, switch on their phone, first go through their Facebook feed, then go through the TikTok feed, clicking on our ads. So every day is Hedgehog Day, just like for electricity plant, where every morning people switch on the light. Luckily, also with an underlying long-term growth trend that is currently making that each day is then a little bit higher than the other, even though the intraday pattern is the same pretty much every single day. Last, the outlook. So the directors are confident in the group's strategic investments, in our innovation, integration, and global expansion. And this is why we expect that we will perform at least in line with the current market expectations for this year. And with our high cash reserves, strong operating cash generation, and a committed credit facility, the company is fully funded to execute a strategy to simultaneously invest into its future and also return cash to shareholders. With this, we end our presentation. Thank you for your time and interest in Team Internet, and we are now open for Q&A.
Thanks very much, Michael, Billy, for a very interesting presentation. We've got a couple of questions that have come from delegates so far. So William is asking for some more details about the adjusted cash flow. Yeah. I think that the specific question is the distinction between adjusted and unadjusted cash flow.
Yes. Naturally, I won't go through every single line, but the key components in terms of how we get from GAAP cash flow to adjusted cash flow are very consistent items to the items that we use to differentiate between operating profit and adjusted EBITDA. So the most significant example is we add back cash outflows in respect of non-core operating expenses. The reason why we exclude those from adjusted cash flow and why we believe adjusted cash flow is a more relevant metric is because those non-core operating expenses are by their very nature non-recurring and non-core by nature, i.e. they are not reflective of the underlying performance of the business. And it's important to us that the metric that we use, we obviously use the gap metric as well, but the alternative performance metric we use is truly reflective of the underlying performance of the business. So that's the largest example of an item we use in getting to adjusted cash flow.
Right, and these expenses could, for example, be due diligence costs, which are then transaction related and have nothing to do with the day-to-day operations of the business. And this is also why we segregate the two, to basically not distort the view on our operation performance, which is the adjusted EBITDA, and the non-core expenses are of course expenses which go out of pocket, but have nothing to do with the day-to-day operations, and then bring new fantastic assets into the group, like for example, Team Internet AG many years ago, which have led to the fundamental and very profitable pivot of the group over the last 3.5 years.
Thank you. Yes, that's helpful. Can I just remind delegates, if anyone else would like to ask a question, just click the Q&A button at the bottom of your screen and type your question into the box. Bill is also asking, did you assume any debt or gain any cash with the acquisition of Adrenalabs?
Yeah, that's a very good segue from talking about non-core operating expenses, of which due diligence costs incurred by way of M&A activity is a good example. So we have had this one acquisition this year, which is immediately accretive to the business, and the good news is very clearly we did not assume any debt as a result of acquisition. There is a small amount of cash that we've acquired with the company, but it's not whilst it will be visible in our financials. We didn't acquire a material amount of cash, but it is a transaction that will decrease net debt, not increase net debt, because we acquired cash but no debt.
Thanks. Then question I'd like to ask, I noticed you mentioned in your presentation that you are now only looking really at bolt-on acquisitions. Can I just ask about your acquisition pipeline? Is there much in the pipeline at the moment, or have things quietened down?
Well, first of all, we've taken a deliberate hiatus from M&A, which we've now ended with the transaction announced on the 1st of September, focusing on other priorities, more on cost management and keeping organic growth high, even in a difficult economic environment. And you've seen the success on this on the financial highlights slide. And the pipeline is good, and yet we are ever more selective today with the success that we had on the M&A side in 2021 and 2022. We basically brought all the elements that we needed to implement our strategy in-house, and future M&A is therefore much more selective, because the must-haves we've delivered, and now we are basically adding nice to haves, and Adrenalabs is clearly a nice to have. Would our business work without them? Yes, absolutely. Will it be even greater with Adrenalabs? Yes, absolutely. And this is why we're happy to deliver this deal. And this virtuous circle slide is probably already more than a year old. However, we've added on purpose the word bolt-on in here, because we also want to make clear we have no intent to build like a third pillar next to online marketing and online presence. All the markets are competitive, so we're going to focus on the two businesses in which we currently excel, and every acquisition will be part of either the online marketing or the online presence segment. And we also want to focus on transactions which are even understandable for the general public, how they fit into our ecosystem.
Thanks very much, Michael. Well, thank you both for a very informative presentation and answers to the questions we have. There are no other open questions at the moment. So with that, I'll draw this meeting towards a close. Just some final closing slides from us. Thank you, Michael, Billy.